Hey guys, this is Mark Shaw's in the Pattern Trader. Recently I got a couple of comments from Abdul and Hassan, and basically they were both asking the same questions. So I thought I would read aloud their comments and questions and then just give you some thoughts of my own. So Abdul says, I've been watching your recent videos and they've been amazing. You speak about many opportunities and you discuss various entries and potential targets, but you don't really talk about how we can manage our risk. For example, where to exit if it doesn't work out, where we would be proven wrong. You have been incredibly accurate with your forecasts and your timing is impeccable. I plan to become an elite member real soon, and thanks for sharing such great information. Well, actually, Abdul, I do talk a lot about risk, and in each one of my emails, I do have a trade risk profile in our elite program. So when you join, you'll be understanding that. And the second was from Hassan. Hassan says, over time, I've been watching and listening to your analysis, and you've been so wonderful. But I've not heard you talk about trade management, which includes but it's not limited to stop loss, take profit. Please, can you demonstrate how you manage your trade from entry to exit? So first off, I have to compliment Hassan and Abdul, because I think most traders are concerned where to enter a trade and how to enter a trade rather than what their risk is and where they're going to exit a trade. So hats off to you. That should be your first consideration. I think, as newbie traders, everybody's thinking how much money they're going to make. And, it's like Mike Tyson says, everybody has a plan until you get punched in the face. And what I mean is you have to look at your trading strategy and see what kind of exposure can you take. Meaning, what would happen if you took 5 losing trades in a row, 10 losing trades in a row, 15 losing trades in a row? Would your account balance hold up? And the thing is, if you adjust your risk management, you could plan for that eventuality. But most traders don't understand position sizing, and so inherently they set up their positions with too much risk on each trade as a percentage of their overall account. So unknowingly, people are picking arbitrary lot sizes because they're thinking how much money they can make if they place a bet with that size and if one goes there. But what would happen if you took 10 losing trades and you lost 3 or 5% on each trade? You would effectively wipe out 50% of your account on 10 trades, and then you would have to make 100% just to get back to even. And unfortunately, this is the hole, this is the grave that most retail traders are digging for themselves. Instead, I advise our members to take position size of anywhere from 0.5% to 2% if you feel really strongly about an idea. Meaning that if you had a $10,000 account and you bet 0.5%, you would lose $50. And so you could easily take 10 losses like that and still be in a good position to recover. So risk management and control of your risk is critical to the long-term longevity and your ability to sustain profits in the market. And I think that this is an idea that most traders don't consider or fundamentally don't understand. So there are many factors that determine stop loss and take profit. Frankly, this is one of the things that I always struggle with. It's a question I always get on my webinars. Where do I put my stop loss? Where do I put my take profit? And the answer is not easy, not because I don't understand what I'm doing. It's just because there are many variables. Where are you getting in a trade? What's your objective for the trade? What's the trading environment? And how much are you looking for on that given trade? And all of that will determine my stop loss and take profit entry and exit parameters. And this is somewhat of an art, not a science. But at the end of the day, I do have very set objectives for my trades. And again, it's really going to depend on where I enter the trade and what my expectations are for a trade. In a moment, I'm going to go and show you how to adjust your trades for risk size and stop loss. So like I said, there are many different considerations that go into risk management, but the three that we can control are position sizing, your holding period, and your stop loss level. Now again, as I said, I typically recommend, certainly if you're just starting or you're not very comfortable, that you implement a 0.5% risk per trade for any trade idea. And that way it's going to be very difficult to get wiped out if you're risking 0.5% per trade. I've had many sequences where I've lost 5, 6, 8 trades in a row, lose 4%, and then on one trade I could make 10 or 20%. So I've lost 7 trades out of 8, and yet I'm still ahead by implementing the correct risk and position sizing. As I said, I'm going to go to a position size calculator and show you how to do that. Now, a holding period is very important. I'm looking to take the bigger moves out of the markets. I'm looking for at least 150 pips on a trade. Sometimes I get 300, 500. It's not remarkable for me to take out 1,000 pips on a trade. That just means that your holding period is a little longer, and the longer your holding period is, the more you're exposed to different risk parameters. So my average trade, I would say, lasts anywhere from 1 to 20 days. I'd say 80% of my trades are in that category. 20% of the time, I'm looking for bigger moves in the market. There are many times in dollar yen last year and this year where I took anywhere from 500 to 1,000 pips out of the dollar yen by sitting in that trade for 3 to 4 months. Similarly with the pound New Zealand, I took out 1,000 pips on the upside recently and sat in that trade for many months. So again, it depends on your holding period, depends on your position size, and then the last category is your stop loss level. Now, a lot of traders make the mistake of thinking that if they have a small stop loss, they can compensate by putting a bigger position size. But my contention is that all that means is that you can die a death of 1,000 paper cuts. Meaning if you take enough stop losses, even if you think you're being a good boy and putting your stop loss 10 or 15 pips away, and you've got a position size that's bigger, if you take enough of those hits, it will add up, and you will just eventually bleed to death. And frankly, I don't understand how you can have a system to put 10 or 15 pips in the market where the average move in these FX pairs certainly are 100, 150 pips a day. And so that to me is just a prescription for paying your broker. And I'm going to talk about chart time frames and entries on another video. So typically my average stop loss is around 50 pips. Most people would shake their head and say there's no way that I could risk 50 pips on a trade. And that's absolutely right if you kept to your normal lot size. So all you have to do is reduce your lot size to accommodate the wider stop loss horizon. So again, risk control is going to be fundamental to the long-term consistency and profitability of your account. And this is just a component that most people don't understand and lack in their trading. So Hassan and Abdul, again, I commend you on asking me those questions. And so what I'm going to do is do a video and show you the different considerations, how I look at putting stop loss levels and take profit, and then how I dynamically alter the stop loss and take profit as a trade moves increasingly in my favor or toward my original objective. Okay, now for Abdul and Hassan, what I'm going to try and do is give you a little bit more insight into my thinking by looking at an anatomy of an actual trade. You can see the date this went out. It was called Dollar Yen Narrow Range, and it was referencing a trade that I had very high expectations for in my email. So I just want to kind of give you what that email looks like, and then I'll break it down. And you can see I was looking at this dollar yen chart, this descending wedge triangle, and then right at this area where I was looking, there was a double top within the context of a descending market. And so I was looking at getting in right at the start of a move, and my ultimate objective was to see a retracement back to the lows around the 104. So here was the actual sell order at 111.61. And here was the trade risk profile, meaning that I was advocating that you start off with a bet of 1% of your overall account, and I had a stop loss parameter of 112.57, which means that I was going to bet 96 pips for a take profit of 108.57. So this would be roughly a 3-to-1 risk reward ratio, meaning that I was looking to make 3 times my risk. And the math will tell you that if you set up a trade where your outcome is 3 times bigger than your loss, that you can actually withstand 72% losing trades and still become a winner. So it's fundamentally understanding math and understanding risk management that is ultimately going to put you in the winning column. In a moment, I'm going to put these parameters in a risk calculator to show you exactly how to establish your parameters, taking a 96 pip stop loss with a 1% risk on your account. And if you do this on all your trades, you will not get wiped out, and you're likely to be profitable in the long run. As I said at the outset, the discussion of stop loss and take profit is a variable depending on my comfort level of where I'm getting in a trade and my understanding of the trade. Ultimately, it's understanding the cards that you're holding. And in the case of the US dollar versus the Japanese yen, to my mind, there were several chart patterns pointing the path and leading me to a certain set of expectations beginning 3 or 4 years before I did this trade in this time frame, and I'll discuss that in just a moment. But beginning in 2015, we saw a very prominent double top where the market went to an all-time high, backed off the high, retested the high, and then formed this double top. Now, a double top price pattern is a reversal price pattern. What it means is leading up to that reversal price pattern, the market was in an upward path, and once that double top in the form of the letter M was revealed, it then ultimately points in a reversal direction. So this is why it is a reversal price pattern. Now, in addition to the double top, we also had a head and shoulders, which is just what it sounds like. This is the left shoulder, the peak is the head, and this is the right shoulder. And once we crossed through the neckline here at 116, this basically indicated that this bear pattern was going to continue, and as you can see, it's continued for quite some time, peaking in 2015 at 126. And in this chart, it's trading at 112, but in the real-time chart, I'll show you it's considerably lower. So once we established those bear patterns, this to me always pointed in the direction that it was going to go. So now once we came to this area, and this is where that email went out, where I suggested to our members to sell it at 111.61 with a stop loss at 112.57 and an initial take profit around 108. But once I kind of see that the market is going in my direction, if it's looking like it's going to make me more money, I then move the take profit dynamically. And all during this time, I was anticipating that once we double top here, that we were going to come down and retest this 104.5 area. And as I'll show you on the real-time chart, that's exactly what happened. So I got in at 111.61 and got out in the low 105s and took 650 pips out of this trade. Now, along the way, I added to my position. But you can see when I got in here, my take profit objective equated to that, and if I got in a trade here, then my take profit was a lot shorter. So again, the discussion of where to put the stop loss and take profit is affected dynamically based on where you are in the market, where you are in the maturation of a trend or a move, and what your expectations are. Now I'm looking at the live chart, the real-time chart of dollar yen on the weekly, and again we can see the double top, bear pattern, the head and shoulders, and then we saw the ensuing descending triangle that occurred. And this was the time frame that I established the trade I was just talking about, where I sold against this little bitty narrow range bar at 111.61, And again, my objective was that I saw this trade coming to these support levels when I put on the trade. And so that was always my objective. And so I was willing to sit in this trade for 3.5 months while it's made its way lower. And in a moment, I will show you the outcome of my trades. But I'm just trying to make the point that every trade is going to have its own objective depending on where you enter the trade. I did enter a trade here, but as you can see, my objective was a lot shorter than where I entered the trade up here, and I was looking at that horizon. So in the end, my objective is really to take a piece of the middle. Once I identify a turn point or a trend, I try and just get a piece of the middle. As you'll see, I got just about every inch of this trade, where I got in here and I got out there. And that was just an outlier, but sometimes the more you practice, the luckier you get. And I ended up taking about 650 pips out on that trade. Now I'm going to show you how to actually size your trades to take advantage and be able to sit in a trade for 3 months and not worry about it. If you have the right risk size, if your risk is not too big, then you can be able to eliminate the emotions, and that is the key to being a long-term and sustainable winning trader. So before I move on to the risk calculator, the position size calculator, I just want to show you this is where I got in the trade at 111.61 and where I entered the exited the trade at 105.17. Made about 650 pips on that trade. You can see that I entered the trade on April 25th and got out August 12th, 3.5 months later. So again, understanding where you are in the chart, understanding the long time frames, understanding your objectives puts you in position to understand the long-term move, and then you just have to calculate your risk size accordingly. As you can see, I did add to my trade as prices went lower, but my objective was different, was smaller. And so in these time frames, I was looking to take out about 150 pips, where when I got in initially, my objective was to take out 300 to 400 to 500. And as you can see, I ended up taking 650 pips. And now I'm going to show you how I assigned the risk values to this trade. So now toggling quickly back to the trade, just to remind you, my sell stop was at 111.61 and my stop loss was 112.57, which meant that I had a 96 pip stop loss and my trade risk profile was 1%. So now I'm going to show you how you can enter those variables on a position size calculator to always understand what your exposure and your risk is at all times. On my screen now is a position size calculator, which name is exactly as it implies. This is going to tell you how big your position size should be for your given risk level. I'm going to put this position size calculator link alongside this video. Frankly, this is not a proprietary. You can find these position size calculators on the internet, but I'm just going to show you how to use this. So you can see that you can use this on any currency, major currencies around the world, depending on where you live. For the purpose of this demonstration, I'm going to assume a US dollar account. Let's just assume a account size of $2,500. Now remember, our risk on that dollar yen trade was 1%. I'll show you how to dynamically alter this risk in a moment. And then remember, our stop loss was 96 pips for the dollar versus the yen. Then we drop down and come and find the US dollar versus the Japanese yen. Click here, hit the calculate button, and this tells us exactly how big a position size we should take. So many times people are intimidated when they see that I'm taking 300, 500, 600 pips out of the market and feel that they need a huge account size in order to do that. And this is completely a myth and a misunderstanding. Whether you have $2,500, $500, or $50,000, if you take a 1% risk with 96 pips, you will just be risking 1% of your account, or $25. And if the world came to an end and you got stopped out and you lost $25 of your $2,500, you would live to fight another day. And this is the key in trading, is living to fight another day and not get wiped out on an indiscriminate random number of trades. So like I said, most times I advocate that our members take only 0.5% risk per trade. And the way you express it here is 0.5. So we would expect, since this was half the lot size, half the risk size, that this would drop in half. We hit the calculate button, and that's exactly what we see. And now you've only going to risk $12.50 of your $2,500. And now hopefully you can understand that it's going to be very difficult to get wiped out if you take the proper risk approach on each one of your trades. So I hope that this presentation was of value, that it provides some insight on a very complex topic. And once again, I want to thank Abdul and Hassan for presenting their questions and providing a learning opportunity for all of us. So until next time, I wish you a healthy and prosperous trading week.